Hello and welcome to On the Money, a weekly look how to get the best out of your savings and investments. In this episode, Sam Benstead is making his final appearance on the podcast before he heads off to pastures new. And as it is his final appearance, I was keen to extract for you as much of his fund, investment trust and ETF knowledge as possible. And this is why we've devoted this episode to explaining our top tactics for what to look out for when researching collective investments. So Sam and myself are going to cover 5 pointers that we've separately come up with, and we're going to start off with fund charges. Now, of course, when it comes to investing, there are no guarantees of a set level of performance, and indeed there are no guarantees that you'll make a positive return, although the history books do indeed show that if you invest for the long term of at least 5 years, ideally much longer than that, then going down the stock market route tends to grow your wealth more in real terms as opposed to leaving your money in cash. While cash is of course safer, its Achilles heel is that cash tends to not keep up with inflation over the long term. However, Sam, one thing investors can control is costs, and this is why it's very important to have a look at fund charges in respect of both active funds, those managed by professional investors, and index funds and ETFs, which passively track the up and down fortunes of a particular index. So Sam, I'll hand it over to you to explain the importance of looking at fund fees.
Thanks, Kyle. So as you say, cost is one of the main things that we definitely can control. And I think when investors look at index funds, cost is especially important because often you might have two comparable products tracking the same index, and the only thing that really separates them is the cost. So there's two big index fund providers, BlackRock and Vanguard, and BlackRock's index fund group is the iShares division. And I think a lot of people are drawn to these two fund managers for their passive options just because they are the largest. And while they are brilliant fund managers and they've been doing this a long time, there are some alternatives to tracking some of the biggest stock market indices that I think are worth considering. So I'll just highlight a few here. And we've seen these all be very popular in our monthly most bought lists as well. So the HSBC FTSE All World Index is very popular. This tracks global shares, including emerging markets, for a low fee of just 0.13%. For the US market, the SPDR S&P 500 ETF, stock market ticker SPX5, which is part of our Super 60 list, charges just 0.03% for American shares, and that compares to 0.07% for the alternatives from BlackRock and Vanguard. So very, very competitive there and vetted by our expert fund research team. For the MSCI World, you can pay just 0.12% with Fidelity Index World, and that's an open-ended fund. And if you wanted an ETF, you can pay the same fee for the SPDR MSCI World ETF with the ticker SWLD. So some great passive options there if you are very cost conscious. For active funds, a higher fee doesn't mean a better fund manager. And actually, often the best fund managers are actually backed by great fund management firms, and they work really hard to keep fees low for investors. So 3 investment trusts really jump out to me for their low fees, but also excellent management. And those are Scottish Mortgage, City of London, and Capital Gearing. So very experienced fund managers there, great long-term records. And those fees respectively are 0.35, 0.37, and 0.56%. So really, really good fees and great long-term performance. Whereas from other active funds, if you're looking at fees above 1%, I think you've really got to figure out why you want to back that fund manager.
And as Sam has explained, with fund charges, it's really important to look for like. So if it's an index fund or an ETF, compare that index fund or ETF against others that are tracking the same market. And in the case of active funds, it's a case of looking at the sector or region that the fund is investing in and then compare charges against competitors to see whether fees are lower, whether they're about average, or they are higher than average. In terms of what is the typical fund charge, for an index fund or an ETF, tracking, say, the S&P 500 index or the FTSE All Share, so a mainstream developed market, you can pay less than 0.1% a year, as Sam outlined. For an actively managed fund, so for an equity fund that's investing globally or in the UK or in Europe or in the US, typically the charge per year is going to be around 0.8% to 1%. And it's what is known as the ongoing fund charge. For me, it's easy to overlook costs, especially when they are quoted as a percentage. But even a relatively small percentage difference can make a big difference in pounds and pence over the long term. While a few percentage points of fees may not seem much over 1 year, over 20 or 30 years, they can seriously reduce your net worth if you're not getting a better outcome, if you're not getting outperformance of an index. For me, there's nothing wrong with paying a premium or paying more for an active fund, but you want to see that performance delivered and add value for you over the long term. We're now going to move on to the second item in our agenda, which is to look under the bonnet. So in terms of looking under the bonnet, I think it's important for investors to find out how a fund invests, take a look at its top 10 holdings, compare those holdings with the index, have a look at how the fund has performed versus a comparable index over different time periods, over 1, 3, 5 years. Now, if you notice that the performance line of the fund is quite similar to the index, this could be a sign that the fund manager is not taking enough active bets. It's not investing differently enough from the index. Now, one metric that some fund firms publish is what is known as the active share ratio. Now, unfortunately, it's not widely available, and fund firms are not mandated to publish this ratio on their fund fact sheets or on other marketing literature. But it's a very useful ratio when it is published to show how active the fund is. So if a fund has an active share ratio of over 80%, that tends to show that the fund manager is investing very differently from the index. If I'm being cynical, if a fund firm is not showing the active share ratio, then I'd potentially question, why is that the case, and is the fund being active enough? So we've already spoken a lot about active funds versus passive funds, index funds and ETFs. And we're now going to come on to our third tactic, which is to mix and match between the two fund types. Now, for me, I think some people are far too dogmatic in taking one side over the other. And of course, there are a lot of vested interests on both sides of the argument about whether to entrust a fund manager or to whether simply own the market through an index fund or an ETF. But for me, it shouldn't be an either or decision. They can both work well alongside each other in a portfolio. Sam, over to you to explain how blending the two approaches can give investors the best of both worlds.
Yeah, I think that's the right way of looking at it. There's no reason to just select passive or just select active. And actually in my personal portfolio, I've got a mixture of active and passive funds. As a broad point, I say passive funds are great at capturing a market. And if you want exposure to global shares or US shares or UK shares, the simplest thing to do is just own passive. And most of the research in most markets points to passive funds outperforming active funds over the longer term. That's not to say that active funds won't outperform, but generally you've got a better chance of winning in the stock market with a passive fund than trying to select one of very many active funds. Not to say you can't do it, but the odds are probably in your favor if you go with a passive fund. But actually, if you look at the way passive funds are made up in the main markets at the moment, you'll see that they're quite concentrated in US shares. So the global MSCI World Index is about 73% in US shares. 8 of the largest US companies are now in the tech sector. So it really is looking more and more like a bet on the US and the tech sector, specifically if you own a passive fund. And that's been a great winning thing for markets over the past 15, 20 years, but it does contain some hidden risk. So actually, one way of thinking about the active-passive combination is to balance your passive funds, which are quite tech heavy, with an active fund, which actively seeks to own cheap shares, for example. So a global tracker fund with a value fund, also looking at global shares, could be a really neat combination.
And as well as costs with index funds or ETFs, it's also important to look under the bonnet and check out which index the fund is aiming to replicate. So, for example, there are a number of global equity income ETFs that track various different indices. And because of this, the difference in performance can be quite stark. I last wrote about this around a year to 18 months ago, and I was really surprised to see how wide the gap was between the best performer and the worst performer over 3 and 5 year time periods. And the reason why is because some of these global equity ETFs follow the up and down fortunes of a basket of shares that are filtered based on a certain level of dividend yield. Some of them focus on dividend track records, so companies that have grown their dividends consistently over a certain number of years, for example, over 6, 7, 8 years or more. And some ETF providers use indices. So when I say indices, it's a selection of different companies that have been screened for different criteria. Some of them use indices that they've actually built themselves. So it's really important to look under the bonnet with index funds and ETFs, as well as the fund fee, check out which particular part of the market is attracting, and then make an assessment on whether you want to gain exposure to that area or those particular group of companies. However, when it comes to researching funds, I think it is fair to say that it is simpler to buy an index fund or an ETF. If you're buying an actively managed fund, there's a lot more other factors that you need to consider. And number 4 on our list is to consider how long the fund manager has been running money for. Like anything in life, experience counts for a lot. So fund managers that have been around the block a couple of times, they will have witnessed a number of market cycles, and they'll be able to draw on their experience, including learning from any past mistakes. Now, of course, a newcomer, so a fund manager that's been running money for a couple of years, they could come in and do a great job. And in the case of younger fund managers, they'll have not just come in and be completely new, they'll have several years' experience as an analyst prior to making the step up to run money. And in addition, there is much more of a team approach nowadays. Long gone are the days of the star fund manager culture. Although I do think, particularly for retail investors, it's very important that there is a key decision maker and that there's credibility and there's accountability and that there is a key figurehead that explains the reasons why performance is not up to scratch if the fund is having a bad spell of performance. However, do also bear in mind with experienced fund managers that the past, of course, is not always prologue. And there have been cases where veteran fund managers have had the best years of performance at the start of their careers when they've been running less money, which means that they can be more nimble and move in and out of stocks quicker.
And they might have had a lot of success at the start of their careers, and actually 10, 15, 20, 30 years later, markets have just fundamentally changed, and the way they want to manage money and the way they were brought up doing it just doesn't work so well anymore, and they haven't been able to adapt to new market environments.
And one final point for me, actually, Sam, is that it is, though, reassuring to see a fund manager in the same post for a long period of time, of say 10 years plus. As you would think, if they've still been in that post for such a long time, then potentially it has been very good performance that has kept them there. We'll now move on to number 5 in our list of tactics to look out for when researching funds, and that is to not buy every fund you like the look of.
Absolutely. And I think this is a really, really important one. So when I started out interviewing fund managers 7 years ago or so, everybody I spoke to was so persuasive, and I wanted to go home and buy their fund immediately. But I think it's really important that when reading fund commentary, when listening to podcasts with fund managers, when watching our videos, you do make a choice which is right for your portfolio, and you don't just try and buy a little bit of everything because the fund manager speaks very confidently and passionately about the market they are investing in. Almost all fund managers will say it's a great time to buy their market, and that's something that myself and Kyle experience and always try and push back against. Because they are salespeople, They're running money, but they're also trying to gather assets as well. So it's very important to look at their fund and think about how it might fit into your portfolio. Think about whether you already have an active or a passive fund, which works in that market. Do you really want to switch out a fund to buy it, or are you going to hold both of them at the same time? So asking those questions is really, really key. And if you don't do that, you might suddenly end up with 30, 40, 50 funds in a portfolio, each with 50 shares. And at that point, you might as well just own a passive fund.
Completely agree, Sam. I think if you've got over 15 or 20 funds, you should really take a hard look at your whole portfolio and consider whether every single fund in the portfolio is bringing something different to the party and earning its keep, and it's adding value to your portfolio. As Sam mentioned, if you own a number of similar funds, say you own 5 or 6 or 7 funds that invest in the UK market, you end up owning hundreds of shares, and your portfolio then ends up looking like the wider market, and it'll perform like it as well. And if you want to own the wider market, then that can be achieved much cheaper through an index fund or an ETF.
A good way of controlling the portfolio could be to do an annual review. You can look at which funds have done well, which have done poorly. You could perhaps rebalance, and then just think about over the next 12 months or 24 months about the sectors and markets that you might want to own that you find interesting, and then go from there and try and build a clever portfolio that you can then stick with for a year or so.
And this now leads me on to item number 6 on the list. So as part of a review of a portfolio, say once or twice a year, it's important to watch out for fund manager changes. So with active funds, there is the prospect of the fund manager or the whole fund management team jumping ship or being moved on internally and replaced by another fund manager or another team. This does pose a problem for investors in regards to whether you should follow the fund manager out the door or place their faith in the new fund manager or managers that are taking over. For me, it's important to assess key person risk. I would consider whether one fund manager is being highly influential in calling all the shots, or whether it's being more of a team approach with a couple of named co-managers or deputy fund managers on the fund. If it's been one fund manager that appears to be calling all the shots, then their departure to another firm or their retirement is arguably more of a blow. Another important thing to consider is whether under a new fund manager, the investment objective and approach is going to change. Now, in most cases, the investment process remains the same as they want to keep investors on side. But if that isn't the case, then it's no longer the same fund as when you bought it. So it is time to consider whether to keep it or move on. Now, a fund changing its investment approach, it's not necessarily a bad thing. There'll be a reason for the change, and that change in approach could actually lead to improved performance. However, if the fund is not doing what you want it to do, it's probably then time to sell. So just to give an example, if you bought the fund for its income purposes, and then it changes to no longer paying income, or the amount of income it is paying reduces quite markedly, then I would then consider moving on. And as well as checking that the same fund manager and fund management team is in place, performance is also very important to assess when you're researching funds. However, in the case of considering introducing new funds into your portfolio, there's the danger of performance chasing, which is number 7 in our list of tactics. Sam, I'll pass the baton to you to explain.
So I think this is something that a lot of investors get wrong initially when they start buying funds. So they look at annual reviews or quarterly reviews or research pieces looking at the best performance over the past 3 or 5 years or so, and they think, wow, that fund's doubled its money for investors last year. I want a piece of that. If only I'd invested a year ago. If I invest now, it might do the same. And I think during the pandemic, a lot of investors, particularly first-time investors, but also experienced ones, looked at the amazing returns from technology shares in 2020 and early 2021, and then piled in at the top of the market, and they're yet to recover what they invested. I think that was a real warning sign that as we're told so often, past performance does not indicate future returns. And this is incredibly true. So looking at the best performers over the past couple of years is actually a very dangerous thing to do.
And it goes back again to looking under the bonnet and assessing, why has that fund performed well? Has it been a favourable backdrop for the way the fund invests, for its investment style? Or has it been a favourable backdrop for the theme or sector it invests in, if it is specialising in a certain area? And the thing I think about when looking at a strong performing fund is trying to remember that fund, it's delivered strong returns for other investors rather than myself. And it's then assessing whether over the next 3 to 5 years or longer, whether that level of return will be sustained, and taking a view on, will performance continue to be as strong as it has been over the past couple of years?
Definitely. So I'd look at a fact sheet if a fund's done really well. And if it's a growth focused fund, just look at the size of the top positions. If Nvidia has, doubled over the past year and it's the top holding at 10%, or like in some investment trusts in early 2020 and 21, Tesla became a very large position, that would be a bit of a warning sign. If a company's done extremely well and it's still the largest position, it shows that they expect it to keep going up. And often with companies, a long run of strong performance is followed by a less good run. For a value fund, a lot of fact sheets will actually put the price to earnings ratio of the portfolio on there. And if a value fund is starting to look expensive, and for that I might say, if the earnings ratio is kind of in line with the market, so that's about 14 times for the UK market at the moment. If a value fund is starting to look expensive, that means they're holding a lot of their winners. I like to see in a value fund that's done well, a cheap portfolio still, meaning that they've sold their winners and they're reinvesting the money back into cheaper shares.
And as ever, diversification is key. If you invest in different assets, different fund styles, different regions, then over time, some investments will do better than others. And over the long term, this should smooth your returns, which helps to keep a lid on risk. And also, as well as smoothing returns, it gives a portfolio ample opportunity to also grow. As well as the dangers of buying a fund on a hot streak of form, with investment trusts, there's also the risk of buying on a premium, which is number 8 on our list of tactics to consider when researching collective investments. So for those not as familiar as others with the investment trust structure, investment trusts trade on a premium when their share price is trading above the value of their portfolio, so the value of the underlying investments, which is known as the net asset value or NAV. And when that's not the case, when the share price is trading below the net asset value, then an investment trust is trading on a discount. Now, in the case of premiums, as a general rule of thumb, I would urge caution of investing in any investment trust that is trading on a premium of over 5% and certainly over 10%. Now, the reason why is because over time, there have been various examples of high premiums not being sustainable. Over time, market conditions change, investor sentiment can also change, and this can have the effect of premiums cooling. And when premiums do cool, that harms your share price total return. One sector that's a case in point is the renewable energy infrastructure sector. So ahead of interest rates rising from rock bottom levels, this sector was very popular with investors. And as a result, the majority, if not all of the trusts in that sector were trading on a premium. So at the end of 2021, renewable energy infrastructure trusts were trading on an average premium of 7.2%. At the time of this recording, in early August, the average trust in that sector is now on a discount of 24.5%. That's been a really big move, and it has harmed the share price total returns of investment trusts in that sector. I won't go into too much detail now while that sector has been out of favour, but the main reason has been rising interest rates, which has meant that investors have been looking to dial down on risk. They've been eyeing up safer alternatives such as money market funds, And as renewable energy infrastructure trusts pay a high level of income, they have been less attracted to taking on risk to achieve that higher level of income. And also with investment trust discounts, just wanted to make the point that while investment trust discounts do offer investors the opportunity to potentially pick up a bargain, it's important to remember that investment trust discounts, they tend to converge to the mean discount rather than to the net asset value. So that is something to bear in mind. So if you see an investment trust on a discount of, say, 15%, that does not necessarily mean that over time that 15% discount will be eliminated. That particular investment trust discount at 15% could be the same as its 5-year average discount figure. So it's not necessarily a bargain in that particular case. Let's now move on to number 9 on the list, which is to be wary of being seduced by a compelling investment story, trend, or theme. Sam, over to you to explain.
So this one is really important, and we're talking here about thematic funds. So these are funds that own shares that all align to a certain investment theme. So it could be artificial intelligence or cybersecurity or uranium. They all have companies that should do well if that type of market is performing well. But actually, the reality is thematic funds generally don't make good investments. So research from Morningstar published recently found that over the past 5 years, only 20% of thematic funds have beaten broader indices. And that's according to data looking at thematic funds versus the MSCI World, if that's applicable to them, or the S&P 500, if that is the most relevant index for the thematic fund. So 4 in 5 not outperforming simple tracker funds, and Morningstar found that the worst culprits were thematic funds in the life sciences, wellness, nanotechnology, and food sectors. And it even found that AI funds only just beat their respective indices over the past 5 years, despite AI really taking off. So you would have done as well out of AI by just owning the US index over actually owning a dedicated AI fund, which I think is really interesting. But there is one exception. So defense thematic funds have done amazingly well recently, but for me, it could be a sign that they are going to go through a less hot period in the future. But I do think thematic funds do have a place in portfolios if you're using them instead of picking your own shares to get exposure to a theme. So with just one ETF, you can pick up a basket of shares involved in a certain theme, and that is a far more efficient and less risky way of picking your own shares to try and build a diversified exposure to an investment theme.
I completely agree, Sam. I think investing in a thematic fund can certainly have a place in a well-diversified portfolio. But the thing to remember is that investing in a long-term theme is over the long term. So you need to adopt a long-term mindset and approach. There is the danger of spotting a theme a bit late on and buying when valuations are high. But I think this is a particular problem if you're investing over the short term as opposed to investing over the long term of, say, 5 to 10 years plus.
And that valuation point is really relevant when the thematic fund is new. Fund management gurus, as we know, are out there to make money. And if they pick up on interest from investors in a certain idea, they're then going to be rushing to build a product that they can sell. That might take them 6 months to a year. And by that time, it might be at the top of the market and you've missed actually the really big run up in share prices.
And in terms of good stories don't always make great investments, another very short point I want to make is the importance of being aware that stock market and economic performance, they're not always aligned. So for example, high economic growth for an emerging market country does not always translate into strong stock market returns. And the other side of the coin, just because economic growth in a particular country or region is sluggish, does not mean that it's not going to make a great investment over the long term. One example is Europe. If you invest in Europe 3 to 5 years ago and invested in the average fund, you'll have made a very good return despite all the noise about how economic growth in Europe is very sluggish and the outlook economically looks bleak. And finally, last but not least, 10th on our list is to position size appropriately. So what I mean by this is in terms of when you invest in a fund, to not have too much exposure to one particular fund. So for around a year, I was writing a column for The Telegraph called Rate My Portfolio, where Telegraph readers would send in their portfolios and ask myself to give my thoughts on their portfolio. There was a number of cases where I saw portfolios come in where the reader had more than 50% in one particular fund. And in some cases, it wasn't like a multi-asset fund where you could have the lion's share of a portfolio in theory in. It was, in some cases, it was one fund investing just in one region and also not globally as well. So I think it's important to not have all of your eggs in one fund basket, as I've just coined a new saying there. But also it's important to not have too many holdings that are too small and therefore too insignificant to make a difference to your overall portfolio returns. If you have a holding of, say, 2% or less than 2% in one particular fund, the chances are it's not going to move the performance dial either way, even if it performs very well.
Yeah, that's a really key point, especially if a fund has done really well and it might have gone from a 5 to a 10 to a 15% stake in your portfolio. And actually that might not be suitable for the type of fund that it is. So yeah, it's really important to keep an eye on position sizes, particularly if you're investing in a niche theme or a sector or a market, rather than a really diversified global option.
I completely agree, Sam. And it goes back to the point made earlier about having a regular review of a portfolio once or twice a year, and rebalancing, which involves selling some of your winners when they have a strong period of performance. Rebalancing allows you to maintain the risk profile of your portfolio that it was when you first put it together. And it's a very important way to keep a lid on risk and not have a portfolio that then becomes too risky for your needs and objectives. That's all we have time for today. My thanks to Sam, not just for today's episode, but for his various podcast appearances that he's made over the years in helping to get across educational information in an accessible manner. And thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. If you get a chance, please do leave us a review or a rating in your podcast app too. We love to hear from you, and you can get in touch by emailing otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website, ii.co.uk. And I'll see you next week.